World Development Report 2014. Risk and Opportunity. Managing Macroeconomic Risk. Building Strong Institutions for Better Policy Outcomes, with Cesar Calderon, lead author, World Development Report 2014.
The government has a unique and pivotal role in macroeconomic management, which is try to manage all the aggregate risks that affect people and the economic system that support them. So the best way for governments to conduct macroeconomic management is to develop a framework that provides policy responses that are not only credible, but are also transparent, predictable, and sustainable. Credible in the sense that people believe that the government is going to follow a policy stand throughout the horizon of the shock that they face. Transparent in the sense that the government has to effectively communicate and be accountable to that policy response. Predictable to the extent that market participants would somehow be aware that the country is not going to provide a policy response that is off the mainstream. And sustainable, that they have to have built-in buffers in order to finance those policy responses. Countries in the world have suffered bouts of inflation. Some countries have gone through periods of high inflation, two-digit inflation, or countries have gone through periods of hyperinflation or three-digit, four-digit inflation. In the case of the latter, in general, central banks have tried to anchor the expectations about the evolution of prices through the setting of quantitative targets. For instance, some countries where there were credibility problems in the central bank, or they had shallow financial markets, or they were small enough to have the capacity to have a central bank, they decided to establish an exchange rate anchor. Exchange rate anchors basically permit them to anchor the evolution of prices through the evolution of the exchange rate. So fighting inflation basically is reduced to fixing the exchange rate. These regimes have been very successful in trying to limit inflation or reduce high inflation. In the case of other countries, what other countries have done is try to establish quantitative targets in the money supply. They have tried to limit the increase of the money supply. These countries have typically had deeper financial markets, and also they put an emphasis on trying to have monetary policy independence. Both monetary regimes, exchange rate targeting and monetary targeting, basically have been very successful in reducing high inflation, from high inflation to low inflation, but they have been unsuccessful in trying to be a monetary regime that guarantees long-term sustainability, long-term development. There is a third regime which countries have used, countries that have already high, low to medium inflation, which is the inflation targeting regime. The inflation targeting regime, unlike the other two, what does is tries to anchor expectations of inflation based on an instrument, which is the policy rate. The success of this regime in trying to keep inflation low and stable depends not only on the better understanding of the monetary transmission mechanism, but also on three strong institutional underpinnings. One, central bank has to be the central bank needs to have a clear mandate, which means that the central bank needs to have a goal, and that goal is that of price stability, and the central bank has to achieve that goal. The second pillar would be having independence, and independence here has a twofold meaning. On the one hand, you have that the central bank needs to have independence from political interference. So it means other government officials cannot interfere in the decision making of the central bank, but at the same time they need to have instrument independence, which means the central bank is going to decide what instrument they will use to anchor inflation expectations and how they will use it. In the case of most of the countries that are inflation targeters, this instrument is the policy rate. Unlike monetary policy, fiscal policy has a wide array of tools. Okay? Governments can support economic activity during downturns using either tax measures, spending measures, or transfers. Too often in the past, developing countries have been unable to implement these counter-cyclical actions. They have basically engaged in spending sprees during good times, and they lack the buffers or the resources in order to finance fiscal responses in bad times. Unlike developing countries, advanced nations have been able to adopt countercyclical policies, and that's pretty much due to the fact that they have strong automatic stabilizers. When downturns take place, there are specific government spending measures that activate. If one think about examples in OECD countries, whenever a recession kicks in, there's an automatic increase in social security spending, old age and health in general, and also unemployment benefits or unemployment compensation. In the case of developing countries, unfortunately, automatic stabilizers are weak. For instance, tax system is regressive. Unemployment compensation is almost inexistent in some countries. And government spending is typically plagued by problems of either not having the resources to finance them because the access to markets by developing countries is pro-cyclical, or due to political economy problems, say agency problems or common pool problems. Fiscal stimulus, say either through tax cuts or increasing spending or greater transfers, first of all should be timely. Actions should not be rushed and should be well targeted. Well targeted to the extent that they have to, the spending that is going to be programmed goes to pre-appraised new projects or already successful existing projects. They shouldn't go to projects that prior have been untested. In this context, the lessons from fiscal stimulus tells us that spending should be focused on two areas. One area would be strengthening social safety nets, so that the government should support the least favored segments of the population and try to avoid a reduction in their spending in either food or education. And second, try to invest in growth-enhancing programs, and most notably in infrastructure projects. But here, the government should have not only a good pipeline of projects, but also all the governance necessary in order to do a better selection and a better assessment of the projects that have to be financed.